Hi, Keith Prather here with an RV demand index update for August. Let me share my screen. Here we go. Sorry, a little clunky. Okay, the RV demand index this month was actually um, pretty stable. I mean, I think that's probably the best way to say it, but at a lower rate than where we would like to see it. So the July index came in at 120.7. That's up from last month, and it's the highest since April. So we feel a little positive about maybe the direction it's moving in, but it is weaker than we have seen, and it's still below the long-term trend line. So it was 0.4% higher month over month and a little bit higher year over year against a little bit weaker trough, but it's still fairly flat, and we know it's still jogging sideways, which is not the kind of signal that we would like to see. And we'll talk more in detail about some of the things that are changing, and I think some reasons to be optimistic about what might be coming next year. Overall, when we look at the retail sales index, then you kind of get that same notion where it's jogging sideways, but still much weaker than the long-term trend line overall. And we do see it still in a moderate range. It's not diving on us, but we would like to see it stronger and like to see it trending upward a little bit. It has been an interesting period of time. Overall retail sales, we see it improving overall. So this is our forecast, and our forecast shows that just in general, consumer spending still seems to be very strong. A lot of consumers are finding the wherewithal to go out and buy what they need. The challenge and the questions that we're seeing, especially in the RV industry, is that they have a lot left over at the end of the month to be able to and go buy what they want. And so discretionary spending, when we see the cash that they have left over, is a little bit weaker than normal, but their normal spending patterns are high. I don't have it in this month, but normally we look at sentiment numbers. So we look at consumer sentiment surveys from a lot of different sources. And generally, they've kind of been a little bit down this month as we move into July and through August, early into September. We're getting some signals that maybe consumer sentiment is a little bit weaker. So we got the tax bill and got a little bit of that shot of positive consumer sentiment in July, but then it kind of swooned a little bit. We saw it get a little bit weaker in August. We're a little bit worried because the Federal Reserve hasn't moved yet on interest rates. Consumers are really hopeful that they're going to start to get some more positive signals from the Fed. We've got a lot of tariff controversy and a lot of tariff issues that are still creating uncertainty. If you haven't, and I know I've said it in some of the videos, but if you haven't, this month we're recording a macroeconomic video for the first time, so go check that out. I'll talk a lot about the consumers. I'll talk a lot about the Fed in there. I tried to keep it very short, less than 10 minutes. So go check it out. But from a consumer perspective, we just see some concern. They're just uncertain as we head into the end of the year. And for the RV industry, where that really comes across is when we think about retirees, when we think about some of the older generation shoppers in the marketplace, that starts to create some concern, even though they have the wherewithal and the cash and the money overall to come out and make a purchase or to upgrade their existing units. They're still just a little bit uncertain about what they want to go do. We are, again, I'm saying this across almost every video, so it's a little bit sickening, but we're starting to see some foot traffic. You see some interest, but we don't see a lot of buyers. And we don't see as many buyers as normal. We're seeing a lot of online interest. You see a lot of dealer show websites seeing a lot of browsing, a lot of people shopping online, but they're not purchasing yet. And so there's still some apprehension out there, kind of creating this problem, or they're not really diving in yet. And we have some ideas on that, but that's creating a lot of uncertainty in the industry. And I know we're having to do a lot of discounting and a lot of dealer incentives to try and move products. So that's kind of where we are. But again, our forecast out here shows a consumer that's very resilient. We get a little bit of a jog sideways between now and the end of the year, where we see retail sales flattening out a little bit. So you're going to hear signals in the marketplace. You're going to see headlines saying that maybe retail sales are sluggish. But really, if you look at it on a long-term trend line, we're still spending at record levels. It's just that it's flattening out. We're not getting a ton of growth out of it. The next year, though, you start to see that acceleration. And the model really doesn't have a lot of the tax benefits built into this. Remember, the average household, regardless of uh, station in life, income levels or age levels, we're going to see the average household get about a $3,000 annual boost from their tax filings, and they're not going to experience that. They're not going to know what that number is until January, February, March, or April. But once they start to see that, some households that are doing very well month to month are going to feel like they have a little more wherewithal, and I think we'll start to see them get out and do a little more shopping. So then this adjusted disposable income, this is the number that we're watching. If you think about all your shopper categories that are under retirement age, those over retirement age, we watch other things like we watch the stock market, and the stock market has been a little bit volatile of late, but generally we're still seeing it touch all-time highs. It really depends on where your money is invested as to whether you're seeing your stock portfolio boom or whether it's just getting some average and moderate growth. um, Still a lot of fear out there in the market. I know there's still a lot of concern about geopolitics and trade and the economy overall. Um, but what we're watching in that upper income household and the retirement incomes is the stock market. What we watch in the rest of the marketplace. So that buyer who's out there looking for the lower price tow behinds, for instance, that buyer is still 30 to 50 years old, in a moderate income household level, typically, living inside in maybe a busier metropolitan area, and this is their getaway on the weekends to be able to get out and do some overnight camping. And some of the things that we see there are being affected more by this particular data point, which is inflation adjusted disposable income. And we're seeing it decelerating overall in this trend that started back in 2023, continues to decelerate, but it's kind of flattened out a little bit at 2%. We think it's running a little bit better than this 1.7, but it's about 2% annually. And that's not a bad number, but it's not a great number. We'd like to see it closer to 2.5 or 3%. And then I think you would see much better foot traffic on showroom floors, and we'd start seeing a lot more buyers across a lot of different age and income levels shopping for some new units. So that's what we're watching overall. I would want to remind you of this, and I think I showed it to you before, but this is still a big factor, is when we look at the generations, we look at retirement, we look at what's coming. I think this is going to really help shape the way you go to market, the way you talk about products, the way you do sales and incentives. And I just want to reiterate one more time for you. We're in a period of time right now where we have this great wealth transfer, where a lot of baby boomers retired wealthy in households and in families that historically have not had a lot of money. And so you finally have a baby boomer who has lived very tight and kept their budgets super tight, and they're spending like they're on their last dime, retiring with 1, 2, 3 trillion million, not trillion, $1 million in net worth. And as they transfer that down into younger generations, this younger generation is suddenly, coming upon $1 million disposable income to go do something with. And a lot of them are deciding that, they can do something different. They can go out and they can buy a new RV. They can go, see the country. They can travel. They can do a lot more than they could before. And my point here is that we're going to see the baby boomer retirements accelerate between now and 2031. About 22 million boomers are going to hit retirement age. Not all of them will retire. And obviously, this kicks those 22 million into a different phase of life where they may decide now is the time to go buy the RV, time to go out, time to travel, while we're still healthy, while we still can. Um, and so that will be an interesting dilemma, and then or benefit. And then you have new entrants, about 2.3 million coming into the workforce. AI and AI job losses are really kind of scaring some of our affluent workers. So there's huge categories of computer programmers and people in high tech industry that make a lot of money that are worried about their future. They're worried about what AI is going to do to their jobs and how they're going to have to transition into something different. And they're working through that process right now, but it's making them sit on their cash. So if they are still seeing a steady income, they're not jumping out and making, purchases of new boats or RVs or some of those things, which is why we see a little bit of a sluggish, we see sluggish foot traffic in some age categories or some household income categories. Once they start to see that they're going to survive in an AI environment and that we actually are going to see a net deficit of about 18 million workers between now and the end of the decade, all of a sudden I think you're going to see them start coming out in droves, and then we're going to start to see them get really interested in getting out in the outdoors again. We're going to see them wanting to spend and to buy. So I think those are all transitions that we're going through right now, and I think that's why at a showroom level you're feeling a little bit of uncertainty. That's why used units are moving maybe a little bit quicker. That's why you're being forced to hit more dealer incentives and discounts. The big question is, when does it turn around? And it turns around, I believe, when we get into September and December and we start to see the Federal Reserve at least start to move a little bit on interest rates. I think that will encourage some buyers to jump back into the market. You'll see the stock market perform better. And when the stock market performs better, a lot of the boomer generation folks who are sitting on strong retirements, when they see their retirement portfolios start to go up, if they're young and they're healthy, they're going to decide maybe it's time to go make that purchase, especially while times are good and dealer incentives are pretty high. I think you could see that convergence of factors really play into your hands. And so timing wise, that would be September for a single rate cut, maybe December for the second one. We hope. I mean, conditions could change. And then you see that momentum build into 2026. And then when they see the benefits of the tax bill, where they start to see a little greater household income in 2026, once they get their tax returns and they see how much more money they saved, then I think you do start to see the consumer come out of the hibernation and the fear, and you start to see some improvement overall. But it could be Q1 or Q2 of next year before you really start to see the acceleration. Until then, it's going to be hit and miss, and we're going to be watching news headlines to try and pick up on a few of the things that we think will stimulate growth. So that's what I had for you this month. Again, a lot of uncertainty and a lot of that news. So I apologize for that. I'm hoping to be able to give you better news when we get into September and we get the actual Federal Reserve decision this month. Hopefully we get a tax cut. I'm sorry, an interest rate cut, and that'll go along with the tax cuts. And then you'll see some better performance overall. But for now, that's kind of what we've got for you. If you haven't done it, watch the macro economic video that I did. It's about 10 minutes and give you a little more color on some of these items. So, all right. Hope everyone's doing well. We'll see you next month. Take care.